Sponsored by Chartered Financial Strategies. You are now watching Tax Bytes.
Okay, welcome to a little bit of an impromptu video posting or episode of Tax Bytes. With the new bill that came out on December 20th, the Secure Act, a lot of new legislation came out regarding the 2019 tax season, the 2018 tax season, and the 2020. There's no way I can cover this even in any real detail on any one topic in a 5 or even a 10-minute tax bite, so to speak. I want to give some highlights. I want to point you to whoever your tax advisor is. Make time to go talk to them on some of these things, as well as plan for things so that you can incorporate the best benefit. A lot of things were extended on the individual side. Things like if you did have your house, you had a mortgage debt that was canceled and it becomes income, they've renewed the exception for personal resident indebtedness. If you don't know what that is, it just means it's a way where that canceled debt is not income and causes a tax problem. Way to handle it. Mortgage insurance premiums are considered interest now. The deduction for tuitions come back to some extent. Some of these are retroactive through to obviously 2019. You have to check and see how retroactive they are. Some sound like they're retroactive back through 2018 and may open some amended returns. Also the medical expense deduction is now back to 7.5% of income versus the 10. And I think that's the key one. There's a litany of energy extenders out there. Some are rather esoteric, but there could be some credits out there for that to look at. The business tax extenders tend to be rather esoteric. I'm not going to go into any detail on that. The kiddie tax rule has changed, has a little bit more relief, it looks like. If you don't know if your kid has unearned income, investment income of sorts, that can create a tax issue at the parent tax rate. So that has changed somewhat. So there may be some relief on that, it looks like. So if you have that kind of income, again, go to your tax advisor and discuss it. If you experience any kind of a federally declared disaster, there's a litany of relief, use of retirement funds, extensions on filing returns, all kinds of things there that may give you some benefit. The other things, there's even like I said, automatic extensions. There's a few other things here that are more, again, esoteric. I'm not going to go through those. 529 expansion plans, there's a lot of coverage on what the old law was there. We're going to go through that, but the new law basically says there's 3 new things you can do. One, you can use distributions for higher education expenses, fees, book supplies. You can use distributions out for that under an apprentice program. It does have to be a certified apprenticeship program. Secretary of Labor, Title Section 1, National Apprenticeship Act is kind of qualifying determiner of that. You can also use it for paying loans. You can use 529 plans for paying loans, school loans, education loans. And third, you can have some ability to transfer or contribute to a sibling's college out of one child's 529 plan to another. So again, check with your tax advisor. Some of these this looks like this may go back through through 2019, back to 2019, made after 2018. So it's a 2019 adjustment there. That's retirement plan filing. I'm not going to worry about that. Let's see. You can have penalty-free withdrawals now on retirement plans related to birth of child or adoption, I guess, related expenses. I don't understand all that in great detail, but if you have anything like a new childbirth or adoption, maybe there's expenses related to that, it looks like there is some benefit that you can reach out into your retirement plan to have covered some of those. In a lot of these cases, you don't necessarily have gone directly to those funds and paid them directly here. A lot of times these funds can be, you paid them and then you pull those funds at a later date to cover the additional funds they didn't directly trace. You're going to need to check with your tax advisor how that would work. A lot of times it doesn't have to be that coinciding, so to speak. They have repealed the minimum age for traditional contributions, or the maximum age, I should say. You can now contribute after 70.5, after retirement. You can contribute. That's changed. It looks like there is no maximum age for contributing to retirement plans. You could not after 7.5. And the required minimum date for taking distributions looks like it's 72 now. Um, Again, check with your tax advisors to be sure and how that will affect if you're already taking RMDs or not. So you may not have to. Let's see, there is some modification for designation beneficiaries. It looks like, I hadn't seen that one quite clearly. I would look at that one, which means if you're having designations to beneficiaries of retirement plans, there may be some opportunities to manage that. I'm not going to go into, I really should have reviewed more of this. A lot of little nitpicky. There's a portability. I'm not going to go through that one. There's a whole lot of retirement plan benefit issues there, opportunities to manage. The one thing I was going to get into also is related to the extension or a late file return. It's one of the latter ones down way down here. It is increased penalty for failure to file. And it looks like it used to be if you had owed no tax, you had a refund, then there was no penalty for late file. Extensions didn't really matter. If you did have it, it was a percent of your tax if you filed late. Now it looks like, and again, we'll have to look at the code section in more detail, but it looks like that there's a minimum of a $435 penalty for filing late. Doesn't look like there's a provision for zero tax owed or refunds. Not sure yet, but it could be as high as 100% of the tax you owe are shown on the return, not owed, shown on the return. So your taxes could be $15,000. You get a refund of $2 because you paid 17 in. You still might have a penalty for filing late. It looks like there's a 60-day grace period in there, but that makes the extension much more of a defense against this than it has been in the past. And so you need to value that extension a whole lot more than you had in the past, whether it's through your tax professional, yourself. You need to get your extension. Even just file it. What I think is everyone should just file one January, done, and you move forward. Does a whole lot to calm the tax season if you can do that. There's nothing to squabble over here when the penalty can be this egregious. You shouldn't squabble over filing an extension. You should just do it or let your tax professional do it and pay them a commensurate fee for doing so. So that's kind of the key thing there. There are a litany of other things that may be in here, specifically around the retirement plan. I myself have to get better on board with that. But this just came out, and I will tell you, a lot of this information will flush out in better detail through the first half of this year, maybe even readdressed second half of the year, and so forth and so forth. There could be some relief privilege things done by the IRS in the interim. Who knows? But my perspective is better be a penny wise and pound foolish kind of a thing. So hope this has been a benefit to you. Please continue to join and watch and subscribe and share. And thank you for watching, and have a good day.